Go.
This is Rob Setigatpour from Stratco Property Solutions. I'm here today with my partner, Mitch Flaherty from B6 Real Estate Advisors. Our guest today is Jeff Feinstein from Lennox Wealth Advisors. A little bit over a month ago, we had an event outlining the proposed tax implications for the real estate community and the upcoming elections. Today, we're going to follow up on that conversation with granular details on proposed case studies and and related planning. Mitch, if you can lead the conversation with some meaningful questions.
Yes, thanks, Rob, and thanks again, Jeff, for coming today. So my first question was regarding the presentation I'm going to go through, as it relates to real estate families. What are life insurance considerations to take into consideration from a business perspective?
Yeah, that's obviously top of mind for a lot of people. So I'm going to pull up a presentation that we put together for the webinar. Can you see my screen okay?
We can, yeah.
So, you asked me to kind of prepare. A lot of your clients are probably thinking about, what outside of our own personal family, what life insurance considerations do we need to make specifically for real estate? So we highlighted 3 examples, and feel free to chime in with any questions, of course. So what's top of mind for a lot of real estate families that are very successful and considered illiquid because a lot of their assets are in tangible real estate is life insurance. Excuse me. Life insurance. I'll go through it one more time. My pen didn't work. Life insurance for the purposes of estate planning. So if you see my cursor, that's topic number 1. And what a lot of people are thinking about is right now we're in a very, very generous estate tax exemption climate, meaning that husband and wife can pass along up to $22 million to their children tax-free. If there was a change of presidency, or even in 2025 when the current estate tax exemption sunsets, that number is probably going to go down to roughly $5 million. That's what Biden has said, and that's what the current sunset provision will change to. So what a lot of people do is they get life insurance to pay estate taxes when they pass away. And later on in the presentation, I'll give an example of how that works. The second example that a lot of real estate professionals consider is called key person life insurance. And what key person life insurance says that if I am the matriarch or the patriarch of the family, and I'm in charge of managing the real estate, and I'm in charge of collecting the rents or helping with the finances, or I serve as the CFO of a company, you get life insurance to basically protect your role within a company or real estate portfolio. So if somebody says, if I pass away, I don't want my family to have to sell the properties because I can't manage them, they might get life insurance on themselves that's owned by the company, the LLC, and the purpose would be to replace their income over a period of time. And the third that's really top of mind, especially with all that's going on, is called buy-sell agreement, buy-sell life insurance. So what that means, and I gave this example last time, is Mitch, let's say that you and I own a building together and it's done incredibly well. And if something were to happen to me, if I were to pass away, you might not want to be in the business of managing that real estate property with my wife, who might not be as experienced as you, or my children. So what happens is you get a life insurance policy on me, I get a life insurance policy on you. And if I pass away, then you might get a life insurance proceeds to buy out my share of that building. And it allows you flexibility. You might not have a relationship with my family or my children, so you can do certain things with that property, like refinance or sell or do a 1031, and give yourself a lot of flexibility.
So, sorry to jump in on a quick question. How do they determine the value at that period in time? Is it done by a third-party appraiser, or?
It's a great question. It's all determined in a buy-sell agreement. So
okay.
If somebody has, a marketable security, it's very easy to know what that marketable security is because like a ticker symbol, like Apple stock. But if someone has real estate, typically in a buy-sell agreement, they would have a third party come up with the appraisal. You're not using maybe the appraisal for tax purposes, but maybe an independent accountant or an appraisal company would do the accounting for you. That's a great question.
Okay, great. I think on our last webinar, we touched on the potential impact of estate tax exemptions could based on legislation or who is in office. Can you talk us through some of the estate planning techniques or strategies to consider?
Of course. So, you know, there's really, I take estate planning and I narrow it down to real estate, and it comes into 3 different tranches. So number 1 is just traditional planning. That's important for everyone. Everybody needs a will, a healthcare proxy, a power of attorney. It's obviously a very, very difficult time. People are dealing with losses of family members during the pandemic. So having a traditional will and estate planning is really important. Sometimes it avoids probate and just allows you to follow your wishes. Advanced planning is also important. So that's really working with an estate planning attorney and your accountant to see how can I get assets out of my estate for creditor protection or protect against estate taxes. And typically what people are doing is they're gifting it to a spouse or they're gifting it to their children. And then other advanced plannings might involve grats, and that's something that I can get to in a whole nother seminar. And then also tax planning is very important. So people are doing what's called family limited partnerships. So basically what they're able to do is that if I own real estate and I'm going to gift real estate to somebody, but they don't own a majority of that real estate, what the IRS allows you to do is discount that amount of real estate. So you might not be gifting the intrinsic value of that real estate partnership. So these are all very technical and you can get granular on it. But definitely, you know, especially with everything going on from a political standpoint, with everything going on in real estate and some assets being depreciated, talk to your accountant, talk to your CPA, and see if there's any strategies that make sense for you.
Great.
So, go ahead. I'm sorry, Mitch.
I was saying, great. Thanks, Rob. Rob, do you have any questions?
Jeff, do you have any other types of, I guess, pass-throughs or images to illustrate what you're doing here?
Yeah, I put together a case study just to show you, you know, just simple example. And I was having some technical difficulties before, but this just shows somebody's, let's say somebody has a net worth of $15 million today in a real estate portfolio, and this is 2020. And what they're worried about is estate taxes if they sell that building. So this building up here, that's a beautiful commercial building in some sort of suburban market. So in this scenario, if somebody has $15 million in a property that grows to $30 million, what they're able to transfer to their heirs is about $27 million. And what that leaves is an estate tax of approximately, in today's current environment, of about $2.7 million. But what they really care about is what happens in 50 years from now. What happens in the year 2057? So even if the estate tax exemption doesn't change, so if it doesn't go down, it doesn't go up, that same portfolio using a 4% compounded growth rate would be worth approximately $60 million. So if John passes away and passes his assets to Jane and they're completely tax-free, and the property grows, you know, during those 50 years, and now it's worth $50 or $60 million, the taxes that Jane will owe when she passes it on to her children or any other beneficiaries is approximately $14 million. So all that this really illustrates is that it's incredibly important to really consider gifting assets at a time like this. If you have the liquidity, if you have the ability and the family dynamics to make it work, and just really what people are thinking about is how can I minimize taxes for my future generations?
And the timeline that someone that fits into that basically where this, for the people that this applies to, they really have until, they should really be either planning, thinking, and executing such decisions by the end of the year in the event that there is a political change.
A lot of people are you know, quickly expediting those conversations just because we don't know what's going to happen. There's so much going on in the world. So if you are going to consider gifting assets, now would be a time to at least start that conversation and working with a financial advisor, CPA, and estate planning attorney.
Can we pull up the next slide? If, you know, if this does apply to someone, you know, how they could contact you and everyone's related contact info.
Of course. Oops. So yeah, my information's there. You can feel free to call, call or email anytime. And, you know, I really enjoyed this. And, you know, I think it's a really great service you're providing to all your clients to, you know, hear from experts in different fields. So thank you so much for the opportunity.
Great. Thank you, Jeff. Thank you, Rob.